Welcome to Business Talk here on businesstech.co.za. As always, I'm your host, Michael Avery, and today we're entering the 3 trillion rand world of pension funds. Yes, that's trillion with a T. It's the kind of number that really makes you sit up straighter, maybe sip your coffee a little slower and wonder quietly if you contributed enough to your own retirement. Spoiler alert, probably not. Well, joining me is someone who lives at the intersection of financial foresight and people strategy, Lindi Monyae, who's a managing executive for corporate benefits at Liberty, which, as we know, is part of the Standard Bank Group. And she's here to unpack how pension funds aren't just giant vaults of delayed gratification. They're also instruments of economic influence, of societal responsibility, and increasingly urgent employee support in a world of debt stress and rising financial precarity. So, Lindi, really good to have you on Business Talk. And there's lots to talk about. We've had the two-pot system and all of the reform. There's talk potentially of prescribed assets being bandied about again. Let's just set the stage. What does the current lay of the land of the pension fund industry in the country look like in terms of the size, the assets under management, and its contribution to our gross domestic product?
Thanks, Michael. It's great to be here. And thank you for the invite to talk about this very important topic, and quite important in South Africa, because if you think about our GDP at current, at nominal terms, our nominal GDP sits at about 7 trillion. And we're talking about an industry, pension fund industry, that has about 3 trillion of AUM, which makes a considerable part of that GDP. And additional to that, if you think about our pension assets ratio to our GDP ratio, we're sitting at just above 65%. So this is a big industry. It has a lot of influence. There's a lot of money sitting within this space. So it is right to say that the pension fund industry and the retirement industry in this country plays a critical role in creating bigger investment opportunities, and also is really the foundation of some of our progress from an infrastructure perspective. So it becomes an enormous influence, not just on financial markets, but also on the trajectory of society overall.
And I think it's a great place to start, because you're talking about ordinary South Africans and their savings, and they're putting that away over a long period of time, and then they've got to draw down from those savings for an equally long period of time. So this is patient capital. It can go into long lead time investments like infrastructure. There's good, what they call in the industry, asset liability matching. Are we seeing that, though? Are we seeing this capital being put to productive use in South Africa?
Well, you rightly state that this is a long-term investment power piece. And if you think about a typical South African, which we deal with on a daily basis, where they work for over 30 years, 40 years, and they're hoping that this capital that they're putting in and investing over a period would assist them in the long term. And we take that money as insurers, and with joint accountability from Boards of Trustees, etc. And we make sure that over a long period, there's good returns that come off this money, and that people can retire with dignity. And so individuals depend over long, actually generational periods, to make sure that they retire with money in the pockets, and that someone is absolutely taking accountability for this long-term investment. So as we see it right now, we absolutely believe that this is the right thing to do, despite the fact that we also have an opportunity with two-pot now being able to pull out some of that money within restricted timeframes and restricted thresholds, of course. We still encourage that people look at it as a long-term plan of investments and also of retirement for individuals.
Yeah, and I think, there's this duality here. Obviously, your first and foremost responsibility is to the individual member, and the fiduciary responsibility to those members to ensure that their money seeks and finds the highest returns that they can, so that they don't outlive their money at the end of the day. But if we can do that in a way that also supports economic growth, if you're investing in independent power projects, for example, and you've got a really good yield, you've got certainty of the off-taker, and it means you can help alleviate load shedding, well, all the better. And I think in most economies, we see pension funds and insurers are the largest institutional investors, meaning that they can shape both the financial and the social outcomes of their countries. Do you think our pension system is embracing that dual role enough?
I think we are. If we just look at what those retirement funds and pension funds are expected to do within society, of course, we look at infrastructure spend, we look at funding for hospitals, roads, housing. But as you said, our primary responsibility is to the member. And so Regulation 28, or what we refer to as Reg 28, provides those frameworks and those controls to make sure that we don't use that without understanding the risk, and that also there's a maximum benefit to the end member without abusing the amounts of money and capital that's available. So what Reg 28 does, it protects those retirement savings by limiting the exposure to certain asset classes, but also encourages diversification so that there is higher yielding assets being invested in to allow for this growth that we're hoping the end member will get after many years of keeping that money with us. But as much as we want those retirement funds to grow through high returns, it's important for us not to be excessive and concentrating investments into one single area. And how we do this is making sure that there's accountability, there's fiduciary duties that both the insurer and the Board of Trustees play in making sure that that's secured. And on top of that, the FSCA, from an industry body, ensures that they keep tabs and oversight on how this is done across all the insurers and across all the pension funds.
And I know Regulation 28 was in the headlines when our offshore allocations were up to 45%, so we could go up to 45% offshore. There were some adjustments made to the classifications around alternatives, so to private equity and infrastructure funds and that kind of thing. Does it go far enough to encourage long-term developmental investments without putting members at risk?
Yeah, I think that the recent amendments have been helpful and they're actually quite constructive. I think if you look at the overall South African situation, there's still a lot to be done to embrace and play a bigger role within our economy and play a bigger role within the development of our economy. We have other avenues. We also, as a country, dealing with a lot of, perhaps in some instances, misuse of money. So you do want to have a balance between having these institutions that are able to provide the capital that's required, giving it enough leeway and within specific opportunities to be able to do that. But I still think that from a Reg 28 perspective, we're being responsible. Our communities are very dependent on this retirement funds. They don't have the leeway of the developed countries where they have other funds available to them. So we're also talking about a very different market to the rest of the global markets. I think that what we have right now deals what is required, but there's always room to look at better options and better opportunities around what we put through as governance and legislation.
How do you see it evolving? Because I know, and I said it right up front, there's this debate that comes back from time to time around prescribed assets. The apartheid government used prescribed assets to dictate to pension funds where they had to invest. And I mean, that kind of prescription makes many in the market uncomfortable. I mean, one can understand that there are guardrails to ensure that there isn't complete concentration risk in one particular asset class. But to start prescribing where you've got to put your capital, I think that's when you start to see investors and pension fund members become slightly nervous. How do you see it evolving in South Africa? Does it need to be more dynamic in how it accommodates the changing investment landscape and the rising social pressures that we're seeing to invest in things like water and roads and clinics and schools and that kind of thing?
Yeah, I think that's going to be a continuous conversation in our country. If you think about what does prescribed assets actually mean, it means that those assets or a percentage of those assets are going to be allocated to certain government approved instruments. And with that, of course, in a country that has the type of history that we have, you would want to put some guardrails in reference to that. So I think there's a lot of conversation that still needs to happen with industry. I think that we must also understand the role of government versus that of the individual member. So there's still a lot of debate, but if I were to think about where we're going, there's a demand for the freedom to make the right decisions for the end member. And there is a balancing act against what the country requires in order for it to grow. And so prescribed assets are still going to be a conversation for the future.
It does boil down to governance in a sense. And, you mentioned the history, and we can't ignore the fact that we've had a history of very poor governance and poor capital allocation, particularly in the public sector. And the real power, as we know, often lies with the trustees here. What's your take on the level of financial literacy and ESG awareness among trustees today? Are they equipped to handle the responsibility?
I think it also starts with the training that the trustees get, both firstly at an individual level and when they take on those seats and those responsibilities. I think there's a lot of programs and development that has now been available through different industry structures that allow for Board of Trustees to have the right knowledge to continuously gain and understand what's available in the markets, for example, around ESG. What are those priorities? What is their mandates in relation to thinking through and making those investment calls? I think that there's a big responsibility put on the Board of Trustees of both umbrella and standalone funds. There's a lot more available than there was previously. And so financial education and investment in education becomes a critical component of what they need to keep up with and understanding, because they're dealing with huge amounts of money and actually, to be frank, a lot of people's futures in their hands. So if I look at the current ones that in the industry we have, even within our own space, I think that they're well equipped and have the relevant information and knowledge to make the decisions that they need to make. But again, can you ever know enough in this area? Not at all. All of us continue to learn. And so that's definitely a future continuation of learning and wanting to know what is best for the member at the end becomes a critical part of what they do.
It's almost a full-time professional job nowadays, to your point, because it keeps on evolving. There's always more that the trustees need to know. At the recent Batsita Winter Retirement Conference, it's just, remarkable the level of depth and detail that trustees, have to get their hands dirty with when it comes to these things. And, the fact remains is that employer representatives are appointed to these boards, and they're not full-time positions. So what advice would you give to boards of trustees trying to balance things like long-term growth mandates with member well-being and the short-term pressures like we're seeing with two-pot withdrawals? And there's now just been another thing that have been added to their long list of responsibilities.
Yeah, having seen how this plays out and having been part of that in my previous life, I think there's a few things that are quite important. The first one is understanding who your member is, because we have different members that require different things for the long term. If you're looking at segmentation with those member groups, the requirements are different. So while we were very eager to say last year that from a two-pot perspective, it is the wrong decision to be withdrawing on those savings pots. If you don't need the money, there are people who have to make a decision between, is it my two-pot savings or is it food on the table? Is it two-pot savings for the future, or is it going to be paying Lisa or paying school fees? So as a board member, you need to keep that in mind. And communication. So communicating to your members is quite important by giving them the right information, by ensuring that they're walking the journey around the changes that are happening from a regulatory perspective so that they can make the right decisions. But secondly, in understanding how are you making decisions with their funds and understanding what those decisions would mean in the future. Thirdly, there's a piece around being able to make decisions in the short term, as we did from a two-part perspective. For example, digitization, the whole industry went into a big spend from an IT perspective and digitization to ensure that this was done timeously and that money had to come from somewhere. And so that's a short-term sacrifice around making sure that we have what is required legislatively while understanding that there's a long-term play that's going on within the industry. And then lastly is to make sure that at an individual level, each of the board of trustees are maintaining the honesty, the integrity for the seats that they occupy, and they themselves are keeping themselves updated and informed, which conferences like the PETSITA become really important. And there's a whole lot more available, again, both locally and globally.
Yeah, that learning is just continuous, as you say. I think two-part is really interesting. And to touch on that point that you raised about the data that it reveals, because I think it almost acts like a new form of employee engagement data, because you can see, okay, who's withdrawing, what are they using the funds for? Is it to repay debt? Is it to cover essentials? And then that can give you a better picture about the real state of your employee financial wellness and resilience. Because I always think there's a danger that we focus too much on the long term, like retirement, and to your point, not enough on immediate financial resilience. So how do you see this, just as maybe a last point, influencing the broader employee and corporate benefits landscape in South Africa, given now that we've got this data and we've got this opportunity to have an annual conversation with our employees?
Yeah. Support was an eye-opener on a number of fronts. I think the biggest one for me was just understanding the type of need that people have for immediate savings, if I can call it that. Just the fact that we had in the industry such high numbers of withdrawals, over billions actually, that we've seen come out and flow out of those pots, is an indication of a financial need that our societies sits with. And then we get into what are they actually taking out that money for? And if you look at some of the splits that we see, it's sometimes having to pay for debts that they've created over a period of time, and there's just haven't been an opportunity to pay that out. Or other people have used this as an opportunity to start looking at paying for things up front, like school fees, etc. So you have a number of people across different segmentations and gender, and mostly women. And we've seen that over 45% of our withdrawals are mainly driven by women. And it's the woman that has to make those deliberate trade-offs about, do I need to keep money for the future, or do I need to address the needs of my family right now? So you see the responsibility sitting within the women's space. You see the age groups that actually withdraw the money, 39 years to about 55 years in the majority. So there's some key insights that are telling us where the strain actually lies financially. And then lastly, it's the issue of financial education. This country needs to embed financial education at much younger levels than we are engaging at this point. If we are only starting to talk about financial education and employee benefits when a graduate is getting into the employee space, or you just entering the employment markets, it's too late. It needs to start at high school level and even younger than that, where you become familiar with money. And so two parts, I think, is just an indication of a broader environment that we really need to tackle as a country.
Preach. Lindy, if I could get financial education and literacy included in the education curriculum, in life orientation, for example, I would be one of the happiest people in South Africa, because I couldn't agree with you more. It's got to start at that early foundational age where we give our young Lindy's, our young Michaels, the tools, and we equip them with the knowledge to make better financial choices. So they don't maybe end up taking out credit card debt when they shouldn't have, and then you're drowning in it. And hopefully those who are withdrawing to pay off that debt have learned that lesson now, and we're actually setting them up for a better financial future. But it really does start with that base. Lindi Monyae, thank you very much, Managing Executive of Corporate Benefits at Liberty, reminding us that pensions aren't just about one day, they're about every day, from how we structure benefits to how we support employees, and also how we use these funds to improve the outlook for South Africa. You can catch more conversations like this at Business Talk on businesstech.co.za. I'm Michael Avery, signing off.